Hello, and welcome to Lesson 26. Today, we're diving into profitability ratios. These ratios are critical because they show us exactly how efficiently a business converts its resources, revenue, assets, and capital into actual profits. It's the ultimate measure of management's performance. I'm Professor Matt. In this lesson, we'll break down the heavy hitters, ROIC and ROE, explain why NOPAT and NEO are your best friends for accuracy, and look at how margins and ROA complete the picture. Let's get started. We start with the two most powerful measures, return on invested capital and return on equity. ROIC tells us how much operating income a company generates for every dollar of capital invested, while ROE focuses strictly on the returns generated for equity holders. The key here is comparison. Both ROIC and ROE should be measured against the firm's cost of capital. When a company earns returns above those costs, it's not just making money, it's creating real value for its shareholders. To get these right, we use operating measures like NOPAT and NEO. By adjusting for non-recurring and non-operating items, we remove the noise and get a much clearer, more robust picture of a firm's sustainable economic performance. Next, we evaluate profitability at different stages of the income statement using margin ratios. These help us understand what's left of each sales dollar after covering various costs from production to interest and taxes. Gross margin covers the cost of goods sold. Operating margin takes it a step further by subtracting operating expenses. Finally, net profit margin focuses on the bottom line, the after-tax operating profits available to the business. Finally, return on assets measures how effectively those operating assets generate income. The secret is to include only the assets that actually produce income in your denominator to keep the analysis accurate. In short, profitability ratios are about efficiency. ROIC and ROE are your heavy hitters for value creation, while margins and ROA provide the detail. Next time, we'll take a deep dive into gross profit margin. See you then.